Barclays Investment Bank values Shell Midstream at $15 a share. This company is currently paying a 20% dividend. Let's value this company. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Shell Midstream stock by analyzing their financial ratios and dissecting their financial statements so we can determine if the stock is a buy or a sell. Shell Midstream is an oil and gas midstream company. Midstream refers to points in the oil production process that fall between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. Let's get started with the model. This is a mid-cap company, 3.7 billion market cap, and they're trading at $9.44 a share. And to get shares outstanding, it's market cap divided by stock price gives you shares outstanding, 392 million. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So if a company has positive free cash flow, it makes it a lot easier for them to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it can make it really difficult to do those things. This company has positive and growing free cash flow each year, so that looks really good. Net income is the profit and loss on the income statement. It's revenue minus expenses. And then net income looks really good. It's positive and growing. The sales look pretty good. It starts at 291 million and jumps way up to 525 million, but then dips a little in 2019, which is a common trend with oil and gas midstream companies. Their revenue goes down from 2018 to 2019. Extremely high net profit margins. Net profit margin is net income over revenue. It's how well you convert revenue into profit. And you can see in 2019, they had more profit than revenue. Let me show you why. So in 2019, the sales were 503 million, gross profit of 418 million, operating income of 215 million. They had 92 million of interest on their debt. But if you look on the bottom of the income statement on net income, they reported $546 million. The reason that is because of the $373 million gain in earnings from equity interest. This is called equity method accounting, and it's a way to record profits when a company has significant influence over another company. When a company holds 20% to 50% of another company's stock, it is considered to have significant influence. The $373 million gain on the income statement is not money generated from this company's operations. It's money generated from the companies they invested in. That's why the net income of 546 million is higher than the revenue of 503 million. Same thing in the prior years, they had a lot of income coming in from those investments. Let's look at a capital structure, $2.7 billion of debt and negative 749 million of equity. If a company has negative equity, that means the liabilities are greater than the assets on the balance sheet. They pay 3.42% interest on their debt, and they don't pay taxes because they're an MLP, Master Limited Partnership. To qualify to become an MLP, a company must generate at least 90% of its revenue from natural resources or real estate. So their capital structure is 100% debt since they have negative equity. Their WACC is the interest rate they pay in their debt, 3.42%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 6.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $8 billion. We divide that by 392 million shares. And we get a calculated stock price of $20.40. They're trading at $9.44, so they're trading at a 54% discount. It's a really strong buy according to the model. Even higher than Barclays. Barclays was $15 a share. This might be the closest I've been to Simply Wall Street. They're at 2061, which is almost identical to what I valued. Their valuation is based off of the average analyst estimate. Let's see where the stock has been trading the past few years. The stock was trading in the low 30s 5 years ago, but it's been coming down little by little ever since, so it's at a pretty low point. Let's look at the historical dividends. So 5 years ago, they paid a 21-cent dividend, and it doesn't look like they've ever cut their dividends. It's a good strategy to start low on your dividend and raise it little by little. This is what investors like to see. And their dividend yield is 20%. To calculate dividend yield, it's annual dividend payments over stock price. The reason it's so high is because the stock price has come down so much. As the stock price gets lower, the dividend yield gets higher. And as the stock price gets higher, the dividend yield gets lower. It's good to remember that a company's financial performance isn't always linked to the stock price performance. A company can be doing really well financially, but their stock price keeps going down. On the flip side, a company can be doing poorly financially, but their stock price keeps going up because the market is forward thinking. The only indicator of stock price is supply and demand of the market. If more people want to buy this stock than sell it, the stock price will go up. And if more people want to sell this stock than buy it, the stock price will go down. Let's look at their financial ratios. Really good PE ratio. The median for the market's 15.7, the average is 17.5. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 6.8, so investors are paying $6.80 for $1 of earnings. They have a high price to sales ratio. The median is 2.0, the average is 4.6. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 7.4, so investors are paying $7.40 for $1 of revenue. Negative price to book ratio, the median is 2.3, the average is 4.8. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're negative since they have negative equity. Equity is total assets minus total liabilities on the balance sheet. They have a decent interest coverage ratio. The median is 3.9, the average is 12.8. Interest coverage ratio is EBIT over interest expense, so they can cover their interest expense more than 2 times. EBIT is earnings before interest and taxes. It's called operating income on the income statement. ROE is negative. The median is 12%, the average is 13%. ROE is net income over equity. They're negative since they have negative equity. They have a really high current ratio. The median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. They're at 7.8, so they can easily cover their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. You generally don't need above 2.0 for a current ratio. If it's above 2, that can be a sign of inefficiency. You don't need that much current assets on your balance sheet. This is the balance sheet, $359 million of current assets. Most of it is cash, $290 million. They have $41 million of receivables, which means they sell on credit. That means they're providing a product or service but not getting paid for it. They'll get paid for it in the future. The reason I said you don't need that much current assets to cover your current liabilities is because you don't want to sit on so much cash. Investors are not investing in a company so they can sit on cash. Anybody can do that. They're investing in a company to grow the company and to provide them a good return. The best way to look at ratios to compare them to similar companies, I've done videos on 39 oil and gas midstream companies, and Shell is right here. And if Shell has a number in red, they're worse than the average. If they have a number in green, they're better than the average. They're a little worse in PE ratio, a lot worse in price to sales. Of course, they're worse in price to book because they're negative. They have a really high current ratio, so it's well above the average. Negative ROE, so we can't look at that. They're 100% debt, so obviously they're worse than the average. And their market cap is about half the average, $3.7 billion. Average is $7.4 billion. But they do pay a really high dividend, 20%. The average is 12%. So a lot of people are invested in these types of companies for these big dividend payments, and as long as they keep receiving their 20% dividend, they're really happy. So to summarize, I have them trading at a 54% discount because the stock price has come down so much. If the stock price was higher in the 20s or 30s, it would be an overvalued stock. But just because a company has bad ratios doesn't mean it's overvalued. You have to look at the stock price and where it's at. And their financials look pretty good. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, get a custom valuation, or just support the channel, you could become a member by clicking a link in the description below. Also, I send every month to my members an Excel file to help them better analyze companies. Thanks for watching.